Hey guys, it's Charley Raine and welcome to Let's Keep It Real. Today we're going to talk about financial literacy. We're talking about budgeting, savings accounts, checking accounts, how to get a loan, apply for a credit card, just the basic things. Everything that you would need to know and the 101 ways to find out if you don't have somebody else telling you. I like it because, let's be honest, we love being smart with our money because I love having money. So yeah, head on with me and we're going to go check out Ann. Some of my friends have credit cards, and it's money that they don't have. But like, what's the benefit of them? What's the benefit of not having them? Like,
so pros and cons.
Okay.
So a credit card, it looks like my debit card. There's a limit on it, right? It might be a $500 limit. It might be a $50,000 limit, depending on how much money you make and what your credit score is, right? Which a credit score is just the way the banks and the lenders decide how likely you are to repay that money. They say, we're going to let you spend, Charlie, we like you. You can have $1,000 on this card. Nice. You can go run up $1,000 at the mall, at the restaurants. You can buy everybody at the bar a round of drinks. But then you have to pay that $1,000 back, right? The debit card, that money comes out of my bank account. With a credit card, I have to pay somebody that money back. And if I don't pay it all back, then there's interest. So, and it's usually pretty high, anywhere from 16 to 22%. Ooh. Right? So I borrowed $100. In a year, if I haven't paid it back, that's another $16 to $22 I owe. If you max that card out, that lowers your credit score. It says you're not responsible.
So using it, I'm not responsible. Right. But not using it, I can't raise my credit score?
So using it, if you use up to 30%.
So 30, okay.
So out of $1,000, if you keep it at 300 or so, that's the best credit score you can get. What you want to do there, if you're worried about it, but you want to build credit, you want to get that cash back, right? You also get some better purchasing protection, right, with your credit card. Some of them will extend the warranty on something you buy. So what you can say is, I'm going to go buy gas, and when I get home, or even on my phone, I'm going to pay that credit card bill right now from my bank account.
With budgeting, I know you were talking about like utilities, phone, rent. You also said something about cars. So like, with cars, how do you do like financing, insurance? Like, how do you go about finding all of that?
So if you want to go buy a car, right, I really like going to a car dealership or like a CarMax or something versus kind of an independent shop. I think you have more protections. Okay. Just in terms of being able to appeal to the manufacturer and things. I personally love what's called a certified pre-owned car. Okay. Right? Because in those cases, the dealership has gone through a checklist from the manufacturer and said, yes, this car is old, it's used, but it meets all these safety things, and we've inspected the brakes, and we've inspected all of this, and we know it's going to meet these standards, and then they usually give you an extended warranty. Okay. Right? But you're not paying for a brand new car. That said, you kind of got to go with what your budget allows. And so most dealerships will offer financing, right? They'll offer to arrange a loan. I usually say, though, go to your bank, and they'll pre-qualify you for a car loan. Oh, wow. So you know what the interest rate's going to be. Okay. That's how much am I going to have to pay, right, in addition to the actual amount that I'm borrowing. And so then you can look at the car dealership and see, what are they offering me? And if they're offering me a 3% car loan and the bank offered me 4%, well, I'm going to go with the car dealership. Makes sense. Right? If the other way around, and a lot of times it is cheaper to go through your bank, but not always. You're going to have to register your car. Okay. And then we're buying gas for it, right? But you also need car insurance.
Why do I need car insurance? What if I'm a good driver? I'm a great driver. I don't hit anybody.
You know what? I tell all of my clients that I want them to have, and you're going to think this is crazy, $250,000 per person of liability insurance, $500,000 per accident of liability insurance. And here's why.
I do think you're crazy.
I know. I know. Because you may be a phenomenal driver. Yes. You are the best driver in the world. Yes. But the reckless idiots on the road, because they're reckless idiots, don't have good insurance. And when they hit you, we have to file on your insurance against an uninsured or underinsured driver.
Oh, that's...
So I'm not protecting you from your driving. I'm protecting you from the drivers of all of the reckless idiots out there in the world. Now, at the same time, if you're looking at... We went back to my budget, and I went, well, there's my rent, there's my electricity, there's my gas bill, haircuts, I got a budget for car maintenance, I got to put some savings, she said. There's no more money for that much car insurance. You do the best you can. Okay. Right? Like everything else in life. you do the best you can.
And so, like, with insurance, is car insurance the only insurance that I should have?
Oh, absolutely not.
There's more.
Oh, lots more. Lots more. You didn't know where all that money's going. That Spotify's looking harder and harder to pay for, isn't it? So if you're renting a place, right, you need renter's insurance. That's usually only a couple $100 a year, which I know it's a lot, right? Mm-hmm. But that protects you if somebody steals your stuff. It protects you if there's a fire. It protects you if there's a flood. And I don't mean a flood like, hey, I live on the 3rd floor. The water's not coming up, to the 3rd floor. But what if your neighbor upstairs leaves the bathroom running, or the toilet overflows, and it floods through and floods into your apartment?
Oh.
Yeah, we want to replace our stuff. The other things you want to get disability insurance. Okay. So disability insurance protects your ability to earn a living. A lot of times you're going to get this through your company, right? The older you get, the more money you're making, the more important it is to have it. Because if you get hurt, right? You get sick, I can't go into work anymore, right? And I'm not talking like I'm sick for a week. I'm talking I had a stroke, or I did something, I got cancer and I can't work for a couple years, or I'm not going to be able to work ever again, right? And nowadays you get a traumatic brain injury, right? You fall and hit your head, and I've lost my short-term memory, which happens, right? It's not common. It's not every day. Yeah. But, I can give you a list of stories. You get MS, right? And now maybe I can't work. Disability insurance is going to pay you a portion of your salary.
Oh, wow.
Every month usually until you turn 65. The other thing is health insurance. Now, if you work for a big company, most big companies offer health insurance. If you work for a small company, they might not offer it. Okay. And so there's a couple of things here. One is that if you get through your employer, that's great, right? They're usually going to pay for part of it, so it's a little cheaper.
Makes sense.
If not, or if what the employer costs is so expensive, you can go on something called the Maryland Health Exchange. Okay, it's a website, state of Maryland set it up. And there's all these different insurance companies that offer insurance plans through it. Oh, wow. Okay, and so when you start off, you enter in what zip code you live in, and you put in how much money you're making this year. Now, here's the catch. If you make under a certain amount, the government subsidizes, pays for part of your health insurance. Okay. But let's say, I just got out of school. I don't make anything this year. So I put in 0, and that's legitimate. But next year I get a job and I make $35,000. Well, what the subsidy is actually calculated on what I make next year when I get the subsidy. Oh. Yeah. And then when you pay taxes the year after that is when they're going to catch up to you and go, oh, no, you shouldn't have gotten all that subsidy. You owe us this money back. So what I can do is educate people that if you got a new job and you're going to be making $35,000, put in the $35,000, and it'll calculate your subsidy based on that. And with health insurance, there's 3 different kinds you can get, right? There's an HMO, a health maintenance organization. Okay. In this area, Kaiser's a really big one, right? And I get all of my health care through Kaiser, right? And if I want to see a doctor, I go to my primary doctor, and if he thinks I need to see a endocrinologist, a cardiologist, an orthopedist, he'll refer me. Okay. But it's going to be within the system. People like that because it's kind of one-stop shopping. I don't have copays or anything else. I just go there and it's taken care of. But I'm limited. If I say, well, I got this weird cancer and I really want to go to Hopkins, guess what? You're paying out of pocket for that. Ooh. Right? Or some people say, I know I have a hip problem. I just want to go to the orthopedist. Why do I have to go to my primary care doctor, take time off work, go see him, and then wait for him to give me a referral to go see the orthopedist? Some people don't like it, right? And it's a personal thing. So you can go what's called a PPO, a preferred provider organization. Okay. And there they have a list of doctors that are in network. You can go see anybody, but they're going to pay more of the cost if you go in network. Okay. Right? And they're going to say, if you go see the doctor, we're going to pay this amount, you're going to pay this percentage, right? Usually they pay 80% and you pay 20%. But 80%? No, they're going to pay 80%. You're going to pay 20%. I never heard them pay 80%. Some of them do. Depends. So I need to know health insurance. You must. Come on, see me. Right? Well, we'll walk you through it.
I'm about to be 26, so that's...
Oh, yeah.
I'm hitting the realities of adulthood.
So what happens is there's a deductible, right? Okay. So the deductible, let's call it $500. It means that the first $500 of medical care you're going to pay for yourself. Okay. Right? But I go into the doctor, and the doctor charges me $750. The bill goes to the insurance company, and the insurance company says, no. Remember we had this agreement? We only pay you $350 for that. Mm-hmm. Right? So of that $350, I haven't met my deductible yet, so I'm going to pay $350, right? Yes. Once I meet my deductible, I would pay 20%, so I pay $70. Okay. Sometimes it's a certain amount for a visit, right? You just pay $50 every time you go to the doctor. But then there's another kind that I really, really like and I think is very valuable for people, and that's called a high deductible health plan. And most of those are, I know you're thinking, you're going, why would I want a high deductible? Yeah. Right? Because here's why. Two pieces. One is that for people who are, especially who are working for a big company, the premiums that you're going to pay are much, much less. So the math we do there is we add up what are my total premiums, what do I have to pay for the insurance, plus what's my deductible. And a lot of times, my total premiums plus deductible, even though my deductible is more, is cheaper on a high deductible health plan. And then if I'm healthy, I just go in and get my annual exam every year, right? Annual exam's covered. I don't have to pay for that. Now I'm paying less. And then here's the coolest part. You can open something called a health savings account. And I know, I'm already telling you, got to buy insurance, your money's going to FICA. Yeah, love HSAs. I love HSAs. Yeah, explain what HSAs are. This is like the coolest thing. This is the coolest thing ever, right? And I know I've been telling people you got to save, you got to get 6 months, and you got to buy renter's insurance, you got to do this. So this is another thing to save for, and I get it. But you can put in as an individual, I think next year it goes up to $3,800. Oh, man. I know, you're thinking, I don't have $3,800. That's okay, we'll get you there, right? I'm going to put money in, and it goes in, I don't have to pay taxes on it. So all that taxes I talked about before, I don't pay any taxes. All goes into my HSA. Good stuff. If I use it for medical, I got that copay. I got a prescription I need. All of that comes out tax-free. So I didn't pay taxes going in. I don't pay taxes going out. The government gets nothing. Sweet. Okay. If I don't use it, let's say I put in $1,000, right, over the course, or let's say $1,200, because no. It gets better than that. Here's the coolest part. Not only, say I put in $1,200, I put in $100 a month. I get to the end of the year. Yeah. I didn't need it because I was healthy. I didn't get sick this year, right? Didn't go to the doctor. That $1,200 is still there. And then inside that HSA, I can invest it in investments. Oh, sweet. Keeps growing. Let's say it keeps growing. You're going to need probably $150,000, $200,000 in retirement to pay for medical costs in retirement. So guess what? I can save all that tax-free. Comes out tax-free on the other end. It's a sweet deal. It's the best thing you can do. So your company may also, if you work for an employer, they may offer something called a 401k. If you work for a nonprofit, it's a 403b. The government is 457, 401a. Just so you know, all those numbers and letters, anytime you see all that, don't get confused. Okay. Right? If you're like me and you have a handy-dandy copy of the IRS tax code sitting by your bed, right, for some light reading in the middle of the night. I know, I'm a geek, right? You pull out your handy-dandy copy of the tax code. You flip to page to section 401, paragraph K. It tells you what a 401k is. If I turn to section 457, that's a 457 plan. Oh, wow. I know, right? It's just the section of the tax code that created these plans. Okay. All of them work the same way. Really? Okay? I'm going to put money in from my paycheck. Sometimes my employer's going to match. I put in $5, they put in $5. Woohoo, free money. Ooh. Right? It goes in. Now, the traditional versions of these plans, right, I put money in before I've paid taxes on it. So I didn't pay all those tax bills. Just put the money in. It's going to grow and grow because I'm going to invest it inside of there. It's going to grow and grow. And when I get to retirement, 59 and a half or later, I take that money out and I pay taxes on it then. Oh, wow. Okay? So then, this guy named Roth, Senator Roth from Delaware.
Gotta love Senator Roth.
I know, he's a genius. Actually, someone on his staff probably wrote the legislation, but we'll give him credit. His name's on it. So, he said, let's flip it. In a Roth 401k, Roth whatever, I'm going to put money in after I've paid taxes on it. You're thinking, why do I want to pay taxes now? Because if you're young, let's say you're 20 years old, I'm probably in a pretty low tax bracket. I don't make a whole lot, right? I pay the taxes now. That money's going to grow and grow and grow. When I get to retirement, it comes out tax-free because I already paid taxes. Do I pay taxes on the seed or do I pay taxes on the tree, on the fruit?
Taxes on the seed.
right?
That's genius.
Yeah, it's awesome. So if your company doesn't have that, right? Now that's the best thing you could do. And if you have that option, you should definitely put aside as much as the match.
Okay.
In other words, if the employer says, I'm going to match 5%, you want to put in 5%.
Okay.
Okay? And if you're young, I recommend that Roth option.
Hey guys, thank you so much for watching. If you liked what you saw in the content that we put out, please be sure to like and subscribe, and then we will catch you all in the next coming videos. Have an awesome rest of your day, and thanks for checking in with us.